We just finished going through Micron's fiscal 2026 third quarter earnings called Materials, and now we want to share our takeaways with everyone. Look, the headline numbers are jaw-dropping, but here's the thing nobody's saying out loud. This isn't your grandfather's memory cycle. The slides argue Micron is quietly rewriting what kind of company it even is. Records everywhere, sure, but the real story is buried underneath. Stick with us because what we found in the fine print changes how you should value this entire name. Let me do the numbers first. The slide shows revenue at $41,460 billion, a 619%. BEPS came in at 25.11, beating consensus by 22.55%. Gross margin 84.9%. The stock up 13.1% to 195.9 to mark a cool 1.6 trillion, crushing quarter, no argument there. But here's where you gotta pay attention. The deck states flat out this is not a standard cyclical peak. According to the report, Micron is attempting a fundamental structural rewrite, going from a cyclical memory commodity trader into a strategic asset provider anchored by long-term contracts, massive deposits, and guaranteed price floors. Think about that. Our take is the beat is the bait. The contracts are the actual fish. Anyone fixated on these three numbers is missing the real game being played underneath them. Now let's talk about how this business has always made money. The slide calls it the legacy Faucet model, and it relies entirely on violent price cycles. Boom, bust, boom, bust. When demand surges, profits spike. When oversupply hits, the whole thing crashes hard. Here's the data that matters. DRAM revenue jumped 67% quarter on quarter, but dig into it. Volume up only low single digit, price up low 60%. NAND revenue up 99%, volume up mid single digit, but price up mid 80%. You see what's happening here? The company's growth is fueled almost entirely by price hikes, not by shipping more bits. The slide itself flags this explosive immediate power, but a precarious margin ceiling. Our read is simple. When you're running on price alone, you're driving a Ferrari with the gas light on. Feels incredible right up until it doesn't. So why does Micron think this time is different? The deck's argument is that artificial intelligence transforms memory from a component into a strategic bottleneck. The slide states memory is now the absolute constraint on AI system bandwidth and capacity, not the chip, the memory. And the supply side is jammed three ways. The filing points to HBM crowding, where high wafer trade ratios actively eat into standard DRAM and NAND production. Then CapEx friction, new fab construction choked by labor shortages, power grid limits, and permitting. And physics, diminishing bit growth per node. Here's the kicker straight from management. Supply tightness will extend beyond CY27, maybe gradual improvement in 2028, but their words zero line of sight on when supply matches demand. Tight supply, strategic asset, demand pouring in. Is that a setup for weak pricing? I don't think so. Here's the weapon Micron just pulled out, and the slide calls it the strategic customer agreement. The structure, per the deck, is take or pay, non-cancelable, with binding minimum volume commitments. Translation, the customer pays whether they take the chips or not. That's the whole point. The slide shows the typical lock runs 5 years, CY26 through CY30, with automotive locked for 3, and who signed up. According to the report, 4 hyperscalers, 3 mid-sized clients, plus a handful of smaller automotive names. Right now, the filing pegs current coverage at roughly 20% of total DRAM volume and about 33% of NAND volume. But watch the bar at the bottom. It sits at 25% today, and management expects, once all planned agreements execute, 50% or more of total revenue permanently secured. Our take is, this is the heart of the entire thesis. Lock up half your revenue during a shortage, and you've quietly turned a commodity faucet into a toll booth. Let me lay out the scorecard because the deck flat out calls this a statistically historic quarter. Revenue $41.46 billion, up 74% sequentially, up 346% year over year, the 5th straight record. But here's the one that stopped me cold. The slide shows $17.6 billion in sequential growth. The largest single quarter dollar jump in company history, not percentage dollars, operating margin 81.2%, throwing off $33.7 billion in operating income. Gross margin 84.9%, a company record more than double a year ago. EPS 25.11, 36% quarter on quarter, 22.55% above consensus. Free cash flow 18.3 billion, an absolute single quarter record. A crushing beat across every metric, no soft spots. But pay attention to the footnote, because Micron prints it right there. The true narrative lies in the pricing structures hidden beneath these top-line figures. I'll read, the trophies are real, but they're pulling your eye away from where the hard questions actually live. Now let's pop the hood because this growth showed up everywhere at once. The slide states both engines contributed 100% of the top line growth. DRAM 76% of the mix, 31.3 billion up 67%. NAND 24%, 9.9 billion up a blistering 99%. Go unit by unit and it's the same tape. The deck lists cloud at 13.8 billion up 78%. Core data center 11.5 billion up an absurd 3%. Mobile and client 11.5 billion up 49%. Auto and embedded 4.6 billion 1%. Every single line ripping higher. But here's the warning label and the company stamps it right on the slide. The engine is burning price as fuel, and once absolute price realization slows, this sequential growth trajectory will immediately decelerate. Read that twice. Our take is broad-based growth feels bulletproof, but when one lever does all the lifting, that same one lever is all it takes to drag the whole thing back down. Okay, here's where the story turns, and you need to pay attention. That 84.9% gross margin is gorgeous, but the slide frames it as a ceiling signal. The unit margins are all sky high. Core data center 87%, mobile 87%, cloud 83%, auto 79%. Every one of them are big. So where's the problem? Right here. The deck quotes management's own FQ4 guidance at roughly 86%. And the exact words, this reflects a meaningful moderation in the rate of price increases. That's their phrasing, not ours. Now here's the honest part the slide adds. Management explicitly rejected the normalization framing. They don't want you saying margins roll over. But the deck's read, and ours too, is that the math dictates gravity is approaching. When the company that's been raising prices tells you the raising is slowing down, you listen. The peak doesn't ring a bell, but this is about as close as it gets. Now let me give the bull case its due, because this balance sheet is a fortress. The slide walks through 4 pillars, and they're stout. Liquidity 30.2 billion in cash investments, 24.4 billion net cash. Deleveraging 4.4 billion in debt knocked out, and the filing notes a credit upgrade to BBB inventory 120 days total. With DRAM, their words highly constrained, which in a shortage is exactly what you want shelves bare. And cash generation 25.4 billion operating cash flow, 7.1 billion capex, 18.3 billion free cash flow. Then look at the timeline. The deck flags December 9, 2026, the Sharpest Act 2-year mark with stated intent to increase shareholder returns. Long-term target, return 100% of excess cash. Our take is straightforward. This is the war chest that funds everything coming next. You don't attempt a structural rewrite without a balance sheet that can absorb a punch, and this one can. Here's the growth story everyone's chasing, and the slide calls high bandwidth memory the sharpest spear in the AI arsenal. The deck states HBM412 High is entering production at roughly 2x the speed of the prior HBM3 generation, with yield maturity significantly accelerated. Faster ramp, faster yields, that's the dream combo. But here's the move that's smarter than it looks. According to the report, Micron is intentionally capping HBM market share to exactly match its standard DRAM share. Why hold back? To prevent excessive trade, ratio cannibalization, and preserve total market flexibility. They're deliberately not flooding HBM so they don't starve everything else. Then the foundation numbers, straight off the slide. HBM4 revenue, over 1 billion already shipped. Data center run rate, over 100 billion. Data center SSD revenue over 5 billion, doubled quarter on quarter. Our read, the spear is real and it's sharp, and management is choosing precision over brute force. Disciplined, and that's rare in this industry. Now let's talk runway because the slide maps 3 horizons stretching way out. Horizon 1 data center CY2026, where the deck states industry server unit growth got revised up to high teens, with bit shipments expected to more than double versus 2 years ago. Horizon 2, automotive, ongoing. The report says L2 tough vehicles require 5x the memory of an average car, with penetration expected to cross 20% this year, scaling past 40% by 2030. Then Horizon 3, the wild one, humanoid robotics by end of decade. Robots per the slide require 10x the memory of an L2F vehicle, triggering a massive multi-year secular cycle. And underneath it all, the capex footprint, Idaho ID1 mid-2027, ID2 late 2028, New York under construction since January 2026, ASINCHU EUV mid-2027, and the ASM EUV agreement secured. Our take, these later horizons are projections, not money in the bank yet. But if even the robotics piece half materializes, the demand runway here is measured in decades, not quarters. Alright, here's the slide I tattoo on every investor's hand. They call it Deconstructing the 100 billion illusion, floor versus ceiling. That giant 100 billion number everyone's celebrating. The deck spells out exactly what it is. Lowest enforceable price times minimum enforceable volume over the remaining contract life. It's RPO, remaining performance obligation, and the slide screams it in bold, now guaranteed realized revenue. Now do the math with them. Spread 100 billion over 5 years. That's a 20 billion a year floor. Against an FQ4 annualized run rate of around 200 billion. You see the gap? The floor is a tenth of the current pace. And the near-term reality check is brutal. Of the 5 billion RPO closed in FQ3, only about 1.8 billion actually gets recognized in the next 12 months. Coverage clarification, current volume coverage around 25%, fixed and cap pricing about 40% of revenue. Our rate 100 billion isn't a promise. It's a floor and a low one. Don't confuse the basement for the ceiling. Here's where it gets uncomfortable, and the slide lays it out as Wall Street's interrogation, 4 unanswered mysteries. 4 times the analysts went in hard, 4 times they got stonewalled. Question 1, TD Cowen pushed for the absolute floor price, $10 to $12 a gigabyte. Asked them to verify result per the deck. Management refused to provide pricing. Question 2, BofA probed whether mid 70% is the right margin baseline for 2027 and 2028. Result, refused no guidance beyond Q4. Question 3, Cantor asked if HBM margins reach parity with standard DRAM. Result, refused to quantify, pivoted to RI talk. Question 4, asked for the exact 2027 shortfall numbers. Result, refused only qualitative tightness remarks. And every dodge hid behind one line, floor margins will be well above historical peaks. The slide's analytical takeaway and ours, the most crucial variables for building a real valuation model are being deliberately obscured. Here's the thing. When management won't answer the question that matters most, the silence is the answer. Let me give you the warning lights, because the slide lays out 4 red flags in this structure. Flag 1, price stall equals margin peak. The deck's read, growth was entirely dependent on price expansion, and with FQ4 signaling slower hikes, that 86% margin is highly likely the cyclical top. Flag 2, severe capital intensity. The filing puts FY2026 capex around 27 billion, and FY2027 needs capex higher than FQ4 levels, plus roughly a 1 billion spike in operating expense for R&D. Flag 3, the cyclical backlash. If those supply bottlenecks resolve faster than expected, the slide warns today's sky-high prices and margins take a violent correction. Flag 4, deposit dual-sidedness. Of the 22 billion in agreement commitments, 18 billion are cash deposits, and the deck notes these must be returned in the back half of the contracts, which can mask the underlying cash flow reality. Our take, none of these are deal breakers alone, but 4 amber lights on one dashboard. You drive a little more carefully. So here's the whole thing in one image, and the slide nails it, the ultimate structural gamble, trading upside for survival. On one side of the scale, what Micron gives up. The deck says they're sacrificing cyclical price upside, surrendering the ability to capture those extreme peak spot prices. On the other side, what they lock in, secured downside protection and visibility, is 18 billion in deposits and a quasi-utility model that safely funds a roughly 27 billion capex and R&D pipeline without risking insolvency in the next bust. That's the trade. And then the slide poses what it calls the $1 trillion question, and it's the right one. Is this a permanent structural re-rating of the memory business model? Or is it just a brilliant cyclical peak lock bolting in high prices at the exact top of the cycle? Here's the honest part the deck admits, bulls and bears are both blind without the exact floor margin data. Our take, that one missing number decides everything. Alright, let's land this with a game plan because the final slide hands you a KPI dashboard for the next 4 quarters. 8 things to watch, and I'll give you the ones that matter most. 1 RPO and the 12-month roll-off. Watch the 10Q and 10K to see how fast that contract revenue actually hits the books against the 100 billion headline. 2, DRAM bit growth. Is volume finally growing again? Because that tells you if growth can untether from pure price hikes. 3, the margin trajectory versus 86%. Plot the actual slope of the decline after FQ4. 4, deposit fulfillment. Did the roughly 10 billion in FQ4 cash deposits actually clear? Then HBM4 RAM velocity, FY2027 capex burn, shareholder returns into that December 2026 KPS mark, and the SCA coverage ratio. Is it really marching from 25% toward that 50% plus target? Our take, you don't need to guess on this name. The company just handed you the exact scorecard. Watch these 8, and the truth shows itself quarter by quarter. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.